Good morning. Welcome to Market Monday for October 13th, 2025. Do you notice anything different today? Maybe I look or sound just a little bit different? If so, that's because this is not really me. Funny enough, the cleaning crew that helps keep our video studio looking good accidentally knocked over our video equipment. Thankfully, being in the age of AI, we can still deliver Market Monday to you even without our video equipment. Wait. What? You don't actually like my avatar better, do you? While we don't plan on letting AI take over completely just yet, we have to admit, it does have its advantages. Welcome to Market Monday. Bienvenidos a Market Monday. Benvenuti al mercato del lunedì. Willkommen zu Marktmontag. Marketo Monday e yokoso. What are your thoughts? And now for this week's Market Monday. Last week, the price of gold hit $4,000 for the first time ever. There's no shortage of media coverage about it. And while we can debate the why behind the surge, could be inflation, could be a gradual shift away from reliance on the US dollar by foreign governments, the rapid rise may be causing you to experience FOMO, or the fear of missing out, an anxiety we experience when missing out on a rewarding experience or opportunity that others are enjoying. FOMO is real, so let's put some context to it. Here we're looking at the one-year performance of gold versus NASDAQ and the S&P 500. Obviously, we see gold outperforming these flagship US equity indexes this year, doubling the tech-heavy NASDAQ, hence the fear of missing out. But are we traders or investors? Let's zoom out to 3 years. It's been a great 3-year run in the stock market, and it appears gold just eclipsed the tech-heavy NASDAQ with this most recent surge. But even 3 years would be considered near-term in the stock market. Let's zoom out to 5 years. We would argue maybe 3 years, but really, 5 years is probably the minimum investing horizon, or time frame, you should hold when investing in the stock market. So even with the recent historic surge in gold prices, both flagship stock markets have outperformed gold over the past 5 years. What about 10 years? Glad you asked. Now we're getting into a solid holding period for stocks. So even if you missed out on gold, if you had been investing in the flagship US stock markets over the past 10 years, you still would have been way better off. As a matter of fact, this decade, the 2020s, has been an anomaly in terms of strong performance from both stocks and gold. Here are the annual returns this decade so far. Just incredible for both stocks and gold. But that usually isn't the case, as we see last decade, still very good for stocks, but muted for gold. The opposite for the early 2000s, the so-called lost decade for stocks, and then look at the 80s and 90s, -2 and 3% annual returns for 2 decades in a row. How long would you hold an asset at a 2 or 3% negative average annual return that doesn't pay an income, that costs money to hold, with an unknown future? So if you still feel the need to participate in buying gold, whether that fear of missing out is warranted or not, let's shift the purpose of buying gold from returns to risk management and diversification, that is. Here are some random cherry-picked dates, but they do illustrate the point. January 1st, 2008, through the bottom of the stock market crash during the global financial crisis. Stocks were down around 50%, but look at gold, up almost 10%. Diversification. Calendar year 2022, gold flat, stocks down 18% and over 30% in the case of NASDAQ. Tariff tantrum, beginning of March through the end of April this year. Gold up 15%, stocks down 6%. You get the picture. Gold can be a good equity hedge in times of crisis and uncertainty, but it may be a tough asset class to hold for decades on end. And today, we'll leave you with this. Luxembourg becomes the first EU, European Union sovereign wealth fund to buy Bitcoin with a 1% position. Have a great week.